contract costing. So when you talk about contract costing, it's a form of specific order costing that is applied to relatively large cost units, which normally take a considerate length of time to complete. A good example of contract costing is a building or construction works. So like construction of a bridge, construction of a road, construction of a building. So contract jobs, they are undertaken in accordance with specific requirements. And we have to follow the specific requirements of the contractee. Contractee is the customer. So contracts, they can be distinguished from jobs or job order by the following features. Number one, the money value of the contract is much larger than the money value of the job order costing. Then, a contract consumes a very large amount of resources than a job order. Also, a contract, special progress reports, they are required. Because a contract takes a long time, a long duration of time. So, we need progress reports. They are usually made while in job costing, we only make reports after completion of a job. Because in job costing, maybe a job will take only a day or even an hours, some hours. Your job is to answer. If it takes long, it takes 3 days. Come up show a suit. That's a job order, isn't it? So the costing will take a few days. So we only need to make reports after completion of the job. But for contract, we make reports as the job progresses. And then also another feature is that for a contract, indirect costs are relatively small in relation to direct costs, but for job order, it is vice versa. You find that you have more indirect costs in relation to direct costs. Then, to do this, we have a special account known as a contract account. It is maintained for contract costing. So, a contract account. The contract account, it's a separate account that is opened and maintained for each contract undertaken for the purpose of accumulating costs. So each contract is given a number, and then all costs relating to that particular contract are recorded in that account. In short, I'm saying this. You are working for a contractor. You have seen a contractee, the customer. The contractor is the one that is owning the contract. You have been employed by a contractor as an accountant. Okay? This contractor has 3, 4, 5 buildings that are going on. Okay? So you need to open a separate account for each contract. Okay? Because these contractees, they are your customers. They are different. Just like the way we open the debtors account, the accounts receivable account, the same with contract account. Every contract has its own account. Then a contract account looks like this. You allocate each contract and then you give it a number. So if you have 4 contracts, then you have a policy of your company how you allocate the numbers of the contracts. Are you together? So this one, you can contract account, this one, and then you can give it the number. Then in the contract account, we start with what? Material brought forward. So these contracts, there could be some materials that were not bought, but they were there. That is what you start with. Then you add what? The materials purchased. Then you add the wages, direct wages, indirect wages. Then sometimes in big contracts, we have a contractor who has been contracted to construct a building, isn't it? Then this contractor, when it comes to electrical works, he subcontracts another person to come and do the electrical. Okay? That is what we mean by subcontractor. So that person is paid. Sindio? Tunampea nini? Subcontractor fee. Somebody has been subcontracted to come and do the plumbing works. Tukimlipa, we put that money there. Okay? Then sometimes in the contract, we need a special plant. Okay? We want to excavate a building so that we can start from the basement. Okay? And then to do that, we need what? We need a special machine or a special plant. Okay? And then we go and hire. Okay? That is the amount we put here. Also, machinery or plant brought down. We have a plant, we have our machinery, isn't it? They are there. They move from one contract to another because they are non-current assets. They move from one contract to another. So when we come to this contract, the value of that machinery at the beginning of the period, we put it here. Okay? Then at the end of the period, we are going to put it here. So, another thing that we put here on the credit side is material returned to stores. So there's some materials we purchased here. Okay? We have purchased the material here. We have done our contract, but we have not finished all the materials. So we return some materials to the store. Okay? So we put them here. Okay? Then there's some materials also which have remained. So add them here. Then our machinery or the plant. Right down. So when we started the project or the contracts, we came with a machine, isn't it? Then we have used that machine. We have done a lot of work in that machine. Okay? Then, at the end of the period, we value our machine. Okay? And the value of that machine at the end of the period, we put it here. Okay? So the difference between machinery carried down and machinery brought down, it will be the value that has been consumed by this contract. Are you together? Then from there, you close this. Don't close completely, just put a total there. Okay? When you balance this, okay? But it's the materials. This is only the materials. The materials, the labor, and overheads. Okay? When you close this, you will get our balance carrying down here. Our balance carrying down here will be what? It will be costs of work done. Okay? Yeah. If you balance it here, this will be the cost of work done. Okay? But we're not through with our contract account. So what you do, you bring down this balance here. Cost of work done, brought down. Then you get what? The value of work certified. Then you have the value of work certified, and also you have the cost of work done and but not certified. There is cost of the work that have been certified. Okay, we saw it in the basic terms. The work that has been certified, it has a value. Okay, the work that has been done and not yet certified, you can also ascertain it, isn't it? You put it here. Equal straight line. Okay. Then from there, you get what? The notional profit. If you balance this, you get the notional profit. That's a contract account. So contract costing terminology. Have progress payment. Progress payments, these are the interim payments that are made by the client to the contractor throughout the course of the work. So this is based mainly on expensive contracts or contracts that take a long time to complete. So the basis of this payment is an architect certificate of work satisfactorily done. What I mean is, we have some contracts which are very long. They take a long time to complete. So we cannot wait until we complete the contract so that you can be given the money. Because those contracts, they require materials, we require to pay the labor, we require to repair our machines, and so on. So we have some payments that the contractor receives as the work progresses. That is why it is called progress payment. So the basis of this payment is based on the architect's certificate. And the architect comes, certifies the work, and says up to a certain level, up to a certain level, or up to a certain point, that work is satisfactorily done. So when the architect says that and gives an architect certificate, then the client pays us or pays the contractor. These progress payments, they consist of the sales value of the work carried and certified. So that is progress payment. This progress payment does not refer to the architect certificate, it's a certificate that provides confirmation that work done up to a certain value has been completed. So it is the basis on which these progress payments are made. So that certificate is given to confirm up to a certain point this amount of work is completed and it can be paid this much, okay? And when we are paying that much, then the progress payment on the basis of architect certificate, there is retention money. Retention money, it's a proportion of the value of work certified withheld by the customer for a specified period during which the customer must make good the contractual defects. So, the retention money is calculated as a percentage of the value of work certified. And this amount is later released after satisfactory performance under the contract. What we mean is when the architect has given his certificate, he has certified this work up to a certain value. Let's look at an example of a story building. So a story building starts maybe from the basement. Let's say it has 2 floors in the basement. Okay? Then it goes up another 10 floors. Okay? So what happens? The contractor there will be an agreement with the client that will be paying us the progress payment as per floor. Let's assume it's per floor. Okay? So after we have done with the 2 floors in the basement, that is when you pay us. Okay? So that amount up to that point, you're supposed to pay us 5 million. Just an example. Okay? Then the architects come and he certifies this work, it's okay, it can be paid that amount. Okay? But the customer does not pay the whole amount. There is an agreement that there will be a 20% retention. Okay? Hatampeya zote. He will be paid less some amount. But this amount, the retention money, it is to make good the defects. If, as we continue with the other floors, we find some defects on the previous floors, we are going to use this money to do the repairs. Okay? If there will be no defects, then this money will be released at a later date. Is it clear now? Yeah. Then we have cost of work certified. Cost of work certified. This one, it includes the portion of all the total costs that relate to the work certified. So it is also referred as the cost of sales. It is derived by determining the cost of work not certified and the balances of input charged to the income statement, and then deducting them from the sum of the current costs and the previous period costs brought forward, if there were any costs. So, for the cost of work certified, that portion of the total cost that relates to the work certified. So it is important to determine the profit attributed to each accounting period, and that is when you do the work certified. Then the notional profit. The notional profit is the difference between the value of work certified to date and the cost of work certified to date less provision for any unforeseen eventuality. So you look at the work certified, then you less what? The cost of work certified less any anticipated and unforeseen eventualities. Then there will be the profit taken. Profit taken is that part of the notional profit that is recognized in the current period. So it is carried forward to be recognized in the years that follow. So the contracts usually run for more than one financial year. Okay? So at the end of any financial year, we need to know what was the profit for this year. Okay? That is the profit taken. The part of the notional profit that is recognized in the current period. So it is then carried forward to the subsequent periods. Then, with that, at least you know now those terms because you're going to use them. We can also look at the principles of profit or income recognition. Here, you need to apply the concept of prudence. Prudence. What does it state? When an accountant is faced with various alternatives, he chooses an alternatives which tends to reduce profits. Okay? Yeah, to reduce the reported profits. So, the concept of prudence should be applied when determining the profits or losses to be applied or to be taken on account. So, number one, if the contract is taken in its early stages, number one, if the contract is in its early stages, no profit should be taken. So, it is a 10-story building. Yeah? It is going to take like 5 years to complete. Yeah? So, in the early stages, you don't take any profits. Okay? Until when the outcome can be measured with reasonable certainty. So, during the first stages of a long contract, hata hakuna kazi inaonekana, isn't it? Unaona tu matinga, hakuna kitu zinafanya, na maroli zikibeba mchanga zikirudi, isn't it? Number two, where a loss has occurred, it must be recognized in the period it has occurred, regardless the date of maturity of the project or the timing. So if the loss has occurred, it should be recognized in the period. Sawa? Number three, when substantial costs have been incurred on the contract, but the contract is not near completion. When we have such a situation, a substantial costs have been incurred on the contract, but the contract is not near completion, then the notional profit is apportioned using the formula in order to determine the notional profit. So when you have a substantial contract, but a substantial cost, but the contract is not near completion, and you want to take the notional profit, you apportion. Notional profit is apportioned. What is notional profit? It is apportioned using this formula. Profit taken is equal to what? Notional profit times to that times cash received over work certified. But when the contract is near completion, the profit taken is calculated as profit taken is equals to estimated profit times cash received divided by what? Contract price. Yeah? Estimated profit is equals to what? Contract price minus estimated total cost. And estimated total cost equals to cost incurred to date plus estimated future costs. Like that. Illustration. Sasumo Construction Limited has been awarded a contract to build a house. This is a contract number 45 for the company. And the contract price is 2.65 million. At the end, 2.65 million. At the end of the company's financial year, the contract was 85% complete, and hence regarded as being near completion. You are also provided with the following information about the contract. So there is that information and additional information. A, the portion of work which was completed during the year and certified by the architect was assessed as representing 75% of the whole contract price. The contractee made payments to the extent of 10% retention money. The management of the company decided, for the purpose of preparing the company's annual accounts, to make a provision for a third of the notional profit against the possibility of defects and other contingencies arising later in respect of the work already certified for payment. Required: prepare contract account, compute the amount of profit or loss to be taken to the main profit and loss account of the company, and compute the value of work